Look, the government wants your money. Why? Because they haven't got any money. They don't create wealth, they don't create businesses and create jobs. They just tax those who do. That's the way it's always been. It's just like the kings and queens owned all the land in the UK, and people worked on the land and they took a percentage of their produce. They would give away land to, say, a knight of the realm who fought in the Crusades. Right, you will have Norfolk, you will have Sussex, and all the people in that area worked under that person. He became the lord of the manor or the squire. Peasants worked for them, and you've still got the crown estates. It's the crown property. In fact, really, the land is really owned by the crown and the estate anyway, although you might own a freehold. Do you really own it? But that's another subject. Look, I want to talk about reducing your tax bill and end of year tax tips, and this is why I talk about the government looking for your money, because they're looking to tax us, and when they've run out of ways to tax us directly, they start withdrawing other tax benefits that is basically taking money out of our pocket. So they say we won't increase taxes, but then they'll put more duty on, say, petrol or on alcohol, or they'll take away some of the tax benefits that people like. The winter fuel allowance was a benefit. They've taken that away from old age pensioners. Now, the UK Chancellor Rachel Reeves, or as some people call her, Rachel from accounts, because she lied about the fact she was an economist at the Bank of England. She wasn't. She lied on her CV. All right, it was the LinkedIn CV, but she was actually just worked in the office somewhere. But she's talked about simplifying ISAs, right? What she means by simplifying ISAs, it's in my book, it's taking away the annual tax allowance for the savings ISAs, the ISA you put on a savings deposit account, which is currently £20,000. I think what they're going to do is, I don't know about immediately, but it could happen, is say, well, if you're putting your money into a stocks and shares ISA, then you'll get a larger allowance than if you put it into just a savings deposit account. Like you go into your local bank, you say, I want an ISA, and they put it in a deposit account at, say, 4%, then your money is risk-free, but you're only earning 4%. If you put your money into a stocks and shares ISA, then you've got a chance of real growth over time, but you obviously risk money going, the value of your savings going up or down. So let's look at some of the taxes, because we're drawn to the end of the tax year in April, 5th of April. So now's the perfect time really to start reviewing things, take stock, review your finances, take advantage of any last minute tax saving opportunities. So look, we're going to look at this today, and the first one is getting back to ISAs. An ISA is an individual savings account. It's a tax-free wrapper around your savings. So if you've got money on deposit or in a stocks and shares ISA, all the income from that is tax-free. Forever it's going to be tax-free. Now, if you've got an annual allowance of 20,000, there are also different types of ISAs, junior ISAs, help to buy kind of ISAs which you can use and get a bonus if you're buying a property. So you really need to look into this with your financial advisor. I'm not giving you financial advice, by the way. You've got to get your own advice and do this. But at the moment you can save 20,000. So if you've got 20,000 sitting in another account that's not in an ISA, now's the time to sort of think about moving it over. You can always get it out again if it's in a deposit-based ISA. But if the government reduced that tax-free allowance, then you've lost it forever. And when I was a financial advisor, I remember years ago you had tax relief on insurance policies. So if you had an endowment policy or a savings plan or a life insurance policy, you would get a 15% credit towards the cost of that. And people say, oh, so what? And then suddenly the Chancellor announced at that time, we're going to reduce that, we're going to remove that. And people had like 24 hours to take out a policy, and they were queuing up at offices to take out a policy because, oh my God, it's a fear of missing out. When something's been taken away, they all want it. So just be careful that you don't get caught out like that. Now, the other thing is, number two, is to utilize your pension contributions. Now, this applies whether you're working in a company and you put, say, 3% of your salary into a pension, which is not going to be enough. You could top that up if you want, if you've got the money to do it, because I think you're going to need to put away 10 to 15% for long-term savings to be able to retire comfortably, even retire at all. I think most people will not be able to afford to retire on the type of pensions that are available now. But contributing to your pension grows your retirement fund. It gives you a taxable benefit in the term of tax relief, up to 45% for higher earners. Now, we don't know how long that will last, because they might say, no, a higher rate taxpayers can no longer get the higher rate benefit. It will all be, there'll be one allowance of say 20% or whatever it could be. And again, it's like snatching away something through the back door. I remember the last one of the last Labour chancellors, Gordon Brown, took away tax benefits in pension schemes. He ripped out $5 billion a year from the pensions industry, and so now's the time to use it or lose it. That's the answer. Because yeah, you can go back years, but now's the time to think about it. Don't think about it next year when your accountant says, well, this is what you're going to pay in tax. You've got to decide now and talk to your accountant and say, what tax can I save if I do this, that, or that? Maybe a financial advisor, maybe a good independent financial advisor. Because once a year's gone, it's difficult to go back. You can go back in the terms of pensions, but that's something you have to talk about with your advisor. Number 3 is to claim any allowable expenses. Self-employed, can you claim any deductible expenses? Work out your home office costs, travel, professional fees to lower your taxable profit and in a way, net income. Now you can do this if you've got a business. If you've got any kind of business, an Amazon trading business or a Shopify or a podcast, and you're earning money from that, you can claim things like your home office, your mobile phone. Now you can't do this if you're employed. But if you're employed and you had a little company doing a sideline business, then it changes it. Again, take tax advice on this, but it can be quite a valuable benefit, including traveling to appointments from to and from your office, which could be your home. Okay, number 4 is to use capital gains allowance. You can still take advantage of capital gains allowances and even the last government were cutting this down year by year. But before it resets in the new year, so some people might want to sell an asset, like a taxable asset, like a property, which is a bit late property to sell a property, but shares, they could use up their allowance for that year and then buy back the asset in shares. It's called bed and breakfast in shares. But just do think about that anyway. Think about the capital gains allowance. Number 5 is to gift money tax-free. This is part of inheritance tax planning, where you can use your annual $3,000 inheritance tax gift allowance to pass on wealth without any tax implications in the future. Again, use it or lose it. You've got to use it in this year. So many parents and grandparents who are getting on a bit might think about, well, how am I going to give my estate away to my children? Well, they can use this annual tax allowance to give some money away. If you need advice on inheritance tax, I've got a very good guy who advises on inheritance tax, a really inheritance tax professional who can help you guide through things like wills, inheritance tax planning. I've also got a video out on it. You can check that out on my YouTube channel, Charles Kelly Money Tips Podcast, but I've got a very good video out on that. So again, use your allowances or lose them. And number 6, finally, is to use your accountant, your tax specialist, your independent financial advisor and other professionals to save you money. Now, I'm not talking about a financial advisor just trying to sell you something. I'm talking about a good financial advisor. Maybe they work on a fee basis, but they can really save you a lot of money because they've got knowledge that perhaps you haven't got. And they can find ways of maybe saving you tax or better investing your money and all sorts of things. So do use them. Good advice can really save you a fortune. And really, you're kind of investing in yourself. And again, I've got another video up, 7 powerful steps to transform your finances in 2025. But also I've had a lot of interest in this video about the Section 24 tax hike brought on by the last government, George Chancellor, last couple of governments anyway. He introduced a Section 24 tax hike on people who own properties in their own name. And this meant that they could no longer claim back the interest on their income. They can no longer claim the interest on their mortgage against their income, as all other businesses can do. So there is a way around this. You can look to ways of transferring your properties into a limited company, but without suffering all the tax charges that would normally go with that. So I've got a very good tax specialist, an accountant, a chartered tax advisor that can help you with that if you are in that position. It really affects people who are creeping into higher rates of tax, and those people now are paying more tax because they're not able to claim back the tax relief that they would have claimed on the interest that they're paying on the mortgage. So some are in negative landscape here, where they're actually now suddenly they're not making any profit on their rental income, and they're funding the mortgage out of their own pocket. So remember those things then. Maximize your tax allowance, utilize your pension contributions, your ISA, tax allowance, maximise that, utilise your pension contributions, claim allowable expenses, use your capital gains allowance, gift money tax-free and inheritance tax. Bear in mind the government are collecting an extra 700 million a year from inheritance tax, because the bands for inheritance tax have not gone up for years. They're not going to be raised. So more and more properties are coming into the taxable band on inheritance tax. So people who bought a house, say 30 years ago, maybe for 100,000, suddenly is worth half a million, or even 400,000. Well, that is over the limit to start paying inheritance tax. So a lot of people are creeping into that. So anyway, getting back to the list, gift money tax free, and use your accountants and specialists and good professionals, good independent financial advisors, good accountants. Don't wait. Like some accountants are just bookkeepers. They just tell you at the end of the year, this is how much tax you're going to pay, and pay it to this account for HMRC. No, you want an accountant that will tell you at the start of the year, this is what you've got to do to save tax. I had this years ago. These accountants would never tell me things. I'd find them out myself. I said, well, I thought I could save on this. Oh yeah, you can. Yeah, just give us the figures. I think, why didn't you bloody well tell me that before? So look, that's all for now. I've had a little rant about good advice. So do think about this. You're coming up to the end of the tax year. It's only got about a month to go, a month or so to go. So start thinking about how you can maximise your savings, maximise your investments, and reduce your tax bill. So it's a double benefit for you. Thanks very much, and bye for now.